Well, President Obama's crackdown on risk taking at banks puts a spotlight on one of the most lucrative parts of their business, proprietary trading. Coleman reports on what's at stake as the regulatory belt tightens.
Regulations are wrapping global banks in red tape. From bonuses to lending and now trading, banks are being squeezed to curb risk and head off the next crisis. Obama's latest salvo targets so-called prop trading. Quite simply, this is banks using their own money, not their clients, to play the markets. Governments call this speculative risk-taking. Bankers aren't happy about the new rules.
Policymakers need to be very careful right now not to take actions that end up solving one problem, i.e. there's this cross-subsidization that has occurred in some firms, with another problem, which is making it such that banks can't get capital working to get the real economy going again.
Trading for their own accounts is a critical component of banks' performance. Take Goldman Sachs. Last year, 3/4 of revenue came from the unit that includes prop trading. But there are risks as well. At the end of 2008, almost a third of Deutsche Bank's quarterly net loss came from bad bets in stocks and bonds on the bank's own accounts. Global regulators and economists say banks must raise more money to better absorb losses.
The way forward, I think, is to insist that bank equity ratios are increased very quickly. And you need to make sure they're increased by a very large amount, because it's no point in saying you've got to have a big increase now and you're going to have another big increase in 2 years' time.
The U.S. is not alone in targeting banks trading for their own accounts. Last month, Britain's financial regulator called for banks to double the capital set aside to offset their trading positions. These would take effect next year, tightening the belt around banks even more. Coleman, Bloomberg News.